I'm Scott Staratt with Starratt Wealth Management, part of Canaccord Genuity Wealth Management. Today, I'm very happy. We have one of our managers here who has spent a lot of time educating me on different industries and educating really our clients on what types of investments they look at. And so happy to bring in Mark Tredgett. Mark is a co-founder and managing partner of Vantage Asset Management. Vantage is one of Canada's leading alternative investment companies. Mark's been around for quite a while. He's 20 years plus in the business with significant experience in international and domestic markets. He holds degrees from Western University, where he has his BA in economics, and at the London School of Economics, where he has his Master of Science. So without going into too much about what Vantage is all about, because that's why we have Mark on the line here. I'm just going to kick it over to him with Mark. How did Vantage come to be?
Yeah, it was, well, it's amazing. The time goes pretty quickly. It was over 11 years ago now that we founded the company. And prior to founding Vantage, I was running the alternative investment group at National Bank Financial, where we would research. We had a 7-person team there, and we would research investment ideas that we would actually sell to the bank's Canadian and US alternative investment clients. And did that for a number of years and enjoyed it. But kind of always sort of felt after a while, when you develop a skill set, you think to yourself, well, I don't really want to research these ideas and give them away to people anymore, or sell them to others. I'd rather retain them and do it or sell it myself. And I partnered with my current partner, Darren, who you know well, and he was actually a client of mine. He was one of the individuals that I would contact, and we would work on investments together. And there was a good professional collaboration there, and it was sort of the genesis of starting the firm at the time. Darren's background was he was on the proprietary investment team at the bank. So he ran at TD Bank. He ran some of the bank's money on a hedged basis. And so it was kind of a coming together of two collective skill sets, and feel very fortunate. So it's a really fun profession, and if you're passionate about it and you wake up every day, and it's a privilege, to be honest. It's really enjoy it.
Oh, awesome. I meet with probably, I kept track in 2018, and I meet with about 200 portfolio manager teams in a given year. And I do find you and Darren have, and Vantage as a whole, because I know there's more people there than just the two of you, but you really have kind of a unique process and way of looking at how to make money. There's a lot of managers that'll follow the index, or they'll, even if they don't say they do, they really do. They closet index. There's other managers who, maybe have some success, but don't have a defined process. Can you talk a little bit about what your process is and how you create your portfolio and get your ideas?
Yeah, no, that's a good question. I mean, it really starts, Scott, as you know, with, I like to jokingly say, you have to know, what you want to be when you grow up. And it really starts with, understanding what you're good at and what your team's good at. And philosophically at Vantage, we're passionate about the fact that we think that the Canadian equity landscape, and particularly the small and mid-cap section of the Canadian market, is just rife with inefficiencies. And as an active investment manager, I mean, for people that buy the index, that's fine, and for certain portions of assets, that's a fine strategy. But where you can really generate significant outperformance is finding those, we believe, the off the beaten path investment opportunities that are significantly mispriced. And so it kind of starts with a well-defined target market. And there's probably 500-600 companies that are in our kind of core universe, which is a pretty meaningful cross-section of businesses to choose from. And the portfolio would have somewhere between 20 to 25 at any point in time. So it's a fairly targeted approach, just as a starting point. Philosophically, we start with inefficiencies. The process itself is fairly rigorous. As you know, we're value-based. So we're looking for those significant mispricings where a business, because of, perception, it could be because just a lack of, quite frankly, when you're looking at a market that's not that well picked over, you've got just inherently fewer eyeballs looking at businesses, and a smaller pool of capital chasing opportunities in that cross section, and that leads to some mispricing. So what we're really trying to find is stocks that are significantly mispriced, where an operational or strategic catalyst at some point in the next couple of years can lead to a significant re-rating of the security, and that requires a lot of work and effort. And we've got a 5-person full-time team that's comprised of a nice, sort of aggregation of complementary skill sets. We have a forensic accountant on staff. We've got a former computer science, a mathematics major. We've got 3 ex-investment bankers, a bunch of CFAs. I mean, the team's really comprised of, some high-functioning professional investors, and then we're deploying that effort against a fairly inefficient market opportunity. And you're really looking for those diamonds in the rough. And the process itself is pretty straightforward. You have to source some ideas, and that's sort of, we call it the hopper, to steal a term from tennis. We're looking at our research hopper, and we're working through a number of ideas in that hopper at any point in time. And there's a lot of time we'll work on investments that we end up pushing to the side just because at a certain point in the process they don't, meet the due diligence process. And then some, though, that we review on will get right to the finish line and then end up in the portfolio. And we try and look 18 months plus forward in terms of that being a window upon which that name will have an operational or strategic event to unlock value for our unit holders.
Yeah, one of the things you just mentioned was the idea that the majority of your ideas come from the small mid-cap area. And, the small mid-cap area for Canada, especially Canada, I mean, the US small down there is a few $billion still. But in Canada, it's quite small. And there's been a lot of concern either because of the risk in investing in those type of companies, or the fact that nobody cares. Everybody in Canada either cares about the goals or the financials or the energy, depending on the time of the cycle. How do you kind of protect the portfolio against, being in the small mid-cap area? And second to that is that true that there are a lot of opportunities in the small mid-cap area, but nobody really cares right now?
Yeah, it's a really good question, actually, and I've got a bit of a smile on my face, because you can definitely sense that the apathy for that segment of the market has intensified over the last handful of years. And it's really just a byproduct that at the index level, that segment of the market hasn't performed particularly well. It's certainly significantly trailed larger cap Canadian equities, and unquestionably trailed what's gone on in the US, where it's been a little bit of an equity bonanza for a decade now, with a couple of wobbles along the way. From our perspective, we look at that, and that's it kind of puts a smile on our face, because as there's fewer eyeballs and less capital chasing opportunities, the actual opportunity set is better, meaning that the inefficiencies have been significantly amplified. The one thing that, from a refinement of the process, that you need to do, though, in that environment, is because there can be a lot of value traps. There's not a lot of incremental dollars chasing investments in that segment of the market. So you really need to have those well-defined sort of operational and/or strategic catalysts that will unlock value, or what I like to say is like shine a spotlight on how mispriced a particular company or equities price might be, in order to lead to those re-ratings where you can get those step function improvements in share price. So it's a bit of a double-edged sword. It's made the opportunity set more attractive, but it's also raised the bar a little bit to even arguably have better defined operational strategic catalysts to surface value.
Now, when you talk about strategic catalysts, I mean, that can mean a whole bunch of things. But one of the things that Vantage, I think we've been invested with you now 7 or 8 years. And one of the things I found from when we did our due diligence that long ago is that you really have shifted, and maybe it's a subtle shift or maybe it's an intentional shift, towards becoming more activist. Can you describe what your definition of being activist is, and maybe how Vantage has shifted over the past 7 or 8 years?
Yeah, no, it's a good, I think an astute observation. And there's a number of reasons behind it. I mean, I like to think of us as being more constructivists than activists in a way, because we really try and engage with management teams and boards in a collaborative way. I mean, with our team and the amount of diligence that we do on our investments, I like to think that we have very good rapport with all of the management teams upon which we're invested. When you only have 20, 25 investments, you know, direct contact with management and, when necessary, boards is an important part of our process. I think it's really hard to really understand a business and what they want to accomplish operationally or strategically unless you've got direct access to the key decision makers. As the firm got bigger, both in AUM and team, we just had more capacity and more opportunity to sort of engage at the board level. And I think that I would say that early in the first few years of the firm's incarnation, if we didn't really like directionally where our business was going, we would just be inclined to vote with our feet and sell the security and move on. But in some cases, you'll own a stock that's just so significantly mispriced. And the fixes, for lack of a better word, are actually fairly straightforward and pretty simple. And sometimes, like, even the best of intending management teams, they understand their industry, but they lack a little bit of capital market sophistication. And sometimes the role that we play is to help them understand those pieces of the puzzle and to do certain things, whether it's be more progressive with share buybacks, maybe look at their asset mix and recognize that, you know, in a 4-asset or 3-asset company, that maybe one of them doesn't really strategically fit and should be separated so they can focus on the core. And there's a whole myriad of, you know, we always go into it with a very professional approach. And in almost every instance, I mean, you know, well, because you've been with us for a long time, I think, you know, 17 or 18 different sort of engagements where we've sort of, you know, engaged at the board level. And there's only been 1 or 2 that have been in the public domain. We just find you get a lot more done behind closed doors and working in a collaborative way.
Okay, good. Now you kind of touched on, you know, the disconnect and the apathy a little bit on the Canadian market. Can you delve in a little bit deeper, and you can apply this to U.S. small caps, because I know you do from time to time look at the U.S. as an opportunistic market, but can you talk about what you see as the opportunity right now in this kind of space?
Yeah, I mean, I think that generally there's been, I think we can all appreciate this, and there's been an accelerating stampede towards passive investments. And what that's done is it's you know, daily liquidity, generally larger cap, you know, at least the more widely embraced indices are certainly much larger cap. And there's, as we know, in a passive instrument, there's no price discovery. It's just inflow arrives, and, you know, securities get accumulated, and that leads to what I think kind of a barbelling that's going on in the market, where, like I said, the opportunity set in those names that are not receiving the incremental dollar as a result of maybe not being index constituents is actually better than it was today in terms of the magnitude of the mispricing. Now, there's less of an organic, like a natural bid for that security as a result of not being an index constituent or an ETF, a passive instrument constituent, but the actual mispricing associated with it is arguably got an opportunity to be significantly greater. So you're starting with, I think, a better opportunity set, certainly in Canada, and to an extent in certain cross sections of the US market. But you know, when you've got even in the Canadian context, when you've got a market opportunity that's 400 or 500 businesses, at any point in time, there's always something and when you're only trying to find, 20 to 25 opportunities, there's always something that's unique. Mm-hmm. You know, I mean, today we're looking at a small cap company in the U.S. Right now that's got it's sort of like the tail's wagging the dog. They've got a large pension deficit, which they're now in a position to entirely eradicate as a result of a divestiture sale that they did earlier this year, an asset divestiture. But there's, you know, currently being bantered about in the Congress, there's dialogue about pension reform, like permanent pension reform that would provide relief. So they're kind of waiting on what might happen legislatively. But it's an interesting business because you've got a company that trades at 4 times. It's an IT services business that trades at, 4 times next year's EBITDA, even with a soaking wet penalty for the pension deficit, but a situation that they might be able to resolve here in the coming 3 to 6 months. And the industry trades at, 7 to 10 times EBITDA. So there's always, here we are, everyone's talking about, oh, valuations and tech valuations, everything's gone parabolic. And the reality is there's always something when when you start with from a value-centric approach, which we do, there's always something interesting to work on. And then the team will deploy resources. We've been working on this file for about 6 weeks now. It's not in the portfolio today, but part of my morning was spent on that file, as we would, say in our internal vernacular.
Right. Okay, cool. Now you guys have two funds. You have the Protect the Performance Fund and the Performance Fund. What's the difference between the two? And because I kind of know the answer, in the Protected Performance, how do you protect?
Yeah, no, it's a good question. I mean, and it's sort of a nice luxury because the process is identical. The 5-person investment team's trying to find those 20 to 25 unique opportunities where we think there's a significant re-rating potential over the next 12 to 24 months. After we identify that business, and we've done all of our 360-degree analysis process to determine that, yep, this is a candidate worthy of receiving capital, we'll then make a decision. Okay, is this particular sector that this business operates in, does it have enough of a sufficient peer group that we feel like we can efficiently hedge it using a basket of securities? So we come to a conclusion, and then for the performance fund, we just buy that investment for the portfolio on an unhedged basis. And then the hedged portfolio will allocate that investment, will buy the security, and then typically there's a basket of between 5 and 8 names that will be peers or like companies that operate in that sector or subsector, and we'll create a little mini basket. Like, we almost think of it as being like we call them baskets, but good way to think of it is like almost like a mini ETF. That creates and people say, well, what do you do that for? What we're trying to do in that situation is we're trying to isolate the stock-specific re-rating, that operational or strategic re-rating, without taking on the risk that might accompany a business that operates in that particular sector. So for example, I use an example of a business we're working on, an IT services company in the US. It's not in the portfolio. If it ended up in the portfolio, IT budgets, both operating and capital, at your average public company in the United States is going to have an effect on the IT services landscape. So all the businesses that operate in that sort of defined sector or subsector. So the basket in that particular case would be on the hedged portfolio would be a basket of companies, 5, 6, 7, 8 names that we felt best represented the market and sector risk that we were taking by being long that company. And by setting it up that way, we've then isolated the operational and strategic events, not just the ebbs and flows of the broader market.
Last question. With this environment of COVID and elevated health issues throughout the world, have you found that you've been busier in that there's more opportunities out there now? Or do you find that it's harder to model out your opportunities because there's so many unknowns?
Yeah, it's a really good question, actually. And not to skirt the question, but I think you can appreciate this. It really depends on the industry in which a company operates. I mean, there are certain businesses which you can quite easily model just because of which sectors or subsectors that they happen to operate in. Whereas there are other sectors, let's say airlines or restaurants, where it's quite abstract at the moment, and there's a lot of, how quickly vaccinations are defined and then made available to the broader public is obviously going to have a significant influence on airline travel, both business and leisure, and also on restaurants. And we've had, as you know, here in Ontario, we've had some changes in legislation as it relates to indoor dining just in the last week or two. So it really depends on the sector that a company operates in. And so what you're trying to do in an environment like this is you're trying to take out, as fundamental bottoms-up investors, we like a high degree of certainty. So we're trying to sort of steer clear of those situations where it's harder to model efficiently, where you can look at it and go, I can feel very comfortable this business is going to, as we like to say, meet or beat our expectations over the next 12 months. And typically when that happens, good things happen to share prices.
Right. Okay. Great. Well, thank you very much for your time, Mark. That was really, really a good overview of Vantage and your investment strategy. And from our standpoint, if you do want any more information about Vantage or any of the other managers that we tend to use in client portfolios, please do reach out to us at Starratt Wealth. The best way to do that is over the website at www.starrattwealth.com. And we're more than happy to have a coffee or have a chat and discuss how we might be able to assist you in your investment needs.
That's great, Scott. Thank you very much for having us today. Appreciate it. Always nice to see you.
Thanks.
Take care.